taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
Welcome back to the TMM podcast. Back again with Mr. Steve Moriarty and Tom Hill. How are we, gents? That was a bit loud for you to scare you.
No.
Better than ever.
I'm just thinking TMM. That's right. Right, okay. Total Money Management.
My English accent it's like I've got a mouthful of marbles and I'm trying to say total money management and it just doesn't come out well. So anyway, we're back.
We'll forgive you.
Today we're talking about April Fool's Day and we're through to the 5th of April. But you'll probably be listening to this midway through April just to confuse the situation. But look, the big issue this week, I'd like to kick off with commodities. They've been incredibly unpopular for the last decade or so.
Yeah. 2011, I think.
It's all been about tech, mate.
Yeah, techie and Bitcoin and Nvidia and FANG stocks, and we're saying, well, look, commodities, oil's other commodities have been pretty nowhere for a little while, other than through COVID when oil went nuts. And that's just why we're starting to point the cannon there now. Yeah,
I think it's starting to look. Well, oil, bearing in mind we're recording this on when? April the 6th or something.
Yeah.
So oil's starting to move a little bit. But there's the thing that the Red Sea and the war in Ukraine, those things are starting to influence a little bit. The reason why, and I think I said in the video of the week that was I'm a little bit pessimistic about oil price rising too much. I'm not pessimistic. I'm not sure because it's an election year. And so if oil becomes too expensive, people don't like that. Joe Biden is going to say, all right, let's release oil from the Strategic Petroleum Reserve. That will keep the oil price down. Then when I get re-elected, bingo, we can let oil hit 120, right? Because I'm back in for 4 years. Or, heaven forbid we get Donald Trump. But yes, generally, oil's had a little bit of a bid the last 2 or 3 weeks or something.
Yeah, well, it just seems to be, in my, demographic, I suppose, talking about commodities to people my age, it just seems so boring. They're not interested in it. It doesn't move quick enough. And
it will when the prices move.
Yeah, it hasn't.
Yeah.
But when people start to see there's money to be made.
Well, that's exactly the point, right? It has been boring, so no one wants to talk about it.
Yeah.
And that's why we're going, well, this is why we need to start looking at it.
This is where you get the big returns, right?
Exactly. 100%, Tom. You want to talk about the stuff that nobody else is talking about. Mm-hmm. Right? Yeah. Who wants to, like we said, I think in the last session, who wants to buy a property when it's 11 times income? Sorry, you're not going to make a lot of money unless you think it's somehow going to go to 15. Okay, best of luck with that. I'd rather buy something at 2 times income and, wait for something good to happen.
Well, it's funny, right? If you look at market cycles and investor sentiment, like we've said 100 times and everyone knows buy low, sell high.
Yeah.
But when you buy things that have been out of favor for so long, and like we always kind of reiterate and underscore this point, we don't know when it's going to happen, but if you buy things when they're cheap, at some point they're going to move as long as you're not buying complete rubbish.
Yeah.
If you're buying tried and tested stuff. But it isn't until these things get expensive again that you'll start to see it in the newsletter going, oh, this is a great investment, this is why, blah, blah, blah. And by that point, if you'd invested at the low point, you're licking your lips already.
The money's been made.
But that's when the mugs are jumping in.
Yep.
The mugs. Well, I think that's why we talk...
English mugs. English mugs. Coffee mugs.
That's when me and Jacob are piling in.
Yeah, we get on the top.
How's those junior penny stocks going?
Talking about ourselves.
The penny stocks went nowhere. Might go minus.
Hopefully no one can hear
they weren't cheap. That's the problem. They weren't.
They're cheap now,
though.
Time. No, but my point being is this is why we talk to our clients about ETFs. Because
is it
the sector?
God, that was a good segue.
Yeah, well,
I'm waiting to hear this.
Well, no, the sector itself is cheap.
Yes.
So we're not going in saying go and buy one company.
Yeah, good point. Yeah,
go and buy this specific oil company, and unless you're pretty experienced, right? So we say, okay, well, why don't we talk about the ETF?
Yeah. Absolutely.
10 companies could go nowhere, 90 could do okay, and the overall ETF rises. So
that's exactly right, and that's the way to operate when you're a beginner or intermediate investor. But even I've hold ETFs in my super fund in Well 3 and in Well 2. And see, because we get this idea that you have to buy a stock and that will make you the most money. If you look at the statistics, buying individual stocks is a nightmare.
Yeah.
Right? Your chances, and we've said this before, your chances of being Warren Buffett are like 1 in a zillion, so stop it, right? Just buy cheap ETFs for indexes or sectors or styles, and you will do really, really well, right? But all you're doing is buying cheap over time. Just have a little bit of patience. You've got a systematic approach, and it works over time, right? No, you're not going to get NVIDIA. Sorry, but, you know, whoever bought NVIDIA at 50 cents was basically probably on a speculation, right? Because you imagine, Jacob, if I said, 5 years ago, I've looked at this company, NVIDIA, and I'm convinced it should be worth, $400 a stock. If at 50 cents, you'd be going, you're a dickhead, right? Because, you just can't see that. And that's what I mean. So, those growth stocks are more people piling in rather than any fundamental analysis where people say, look, I've calculated the value and this is unbelievable. There are some out there, but my God, they're one of every 1,000 stocks.
We've almost got to be a fortune teller.
This is probably the best example. Don't know if I've mentioned this before, but I'll never forget because you and I had a sit down when you were kind of coaching me.
Yep.
This was back in 2020, about March, because I've got it in my notes and I was just checking this morning. You were telling me to look at XLE, which was an energy ETF at the time.
Yep.
And I put it on my watch list and I didn't buy it. A year and a half later, it was up 300%. Now, that's an ETF.
Yeah.
I feel like people don't... I'm not saying you're always going to make 300% out of an ETF in that time frame, but for me, that was a massive eye-opener because I always just assumed slow to move.
Yeah.
You're not going to see this kind of capital growth that you could see in a company. And for me, that was when the penny dropped.
Right. It's more Howard Marks. I think Howard Marks said it's either Howard Marks or me. I'm not sure. It might have been Howard Marks.
Basically the same difference, eh?
Could have been.
Wow.
But
Tickets on himself.
When you buy is more important than what you buy.
Yep.
Right?
It's definitely Howard Marks.
Well, yeah, probably is. Yeah. Well, he wrote a book. I wrote a book. Hey, same thing. Now, my point being, when you buy, everybody's horrified, right? Because it goes, oh my God, you're talking about timing the market. Well, yeah. And you know why? Because sometimes things are just really goddamn cheap, right? And if you went, oh no, I don't time the market, it's like, good, I do. And so that was when the oil price was at zero, right? That, the old once in a lifetime sort of thing.
Yeah.
But my point is in regards to that if you buy when everything's cheap, i.e. after a stock market crash, doesn't matter what you buy, you'll probably do all right. Right? You could have bought a value ETF. You could have bought a growth ETF. In 2009, everything had been absolutely smashed. Right? And so you could have bought tech. You could have bought energy. You could have bought consumer discretionary. Right? Because it was all on sale. So it didn't matter what you bought. Right? Now, think about doing that now with the CAPE ratio at 35.
No, it really matters what you buy.
You've got to be a little bit more selective, bro, right? Yeah. And that's what I mean. You've got to be, when the markets are overall cheap, and, I think it was John Templeton, buy when there's blood in the streets, even if it's your own blood, it works, right?
Well, what about the other day on one of the posts on one of the social media platforms? So we had obviously been talking about PE ratios and why they're crazy in tech companies at the moment. And someone went, I used to think that too, but now I realise that high PE ratios are actually a good thing. And I'm like,
that was lightning kiss.
You've just done, let's not, come on.
Yes.
Let's not get petty.
I gave him a reply and he's half right.
Can't help himself.
Only half.
It's
Which
gone
half,
up.
though?
Yeah, well, but
come on.
But that's my point. He said, right, I assume it's a he, she, they said, I didn't like tech stocks, and then I overcame my nerves and I bought FANG.
Lightning.
And now I'm semi-retired. Okay, high PE equals high moat equals high growth. No, dude, you just got fucking lucky, right? Because if you say, I overcame my nerves and I bought FANG, what you're saying is, okay, you don't have a systematic approach to investing. Because I don't buy stocks and go, oh my God, I'm really nervous. You know why? Because I've been doing it for 25 years and I've got an approach. So I don't look at FANG and go, oh man, I'm missing out. Oh my God, I got to buy. You know, Warren Buffett doesn't stand up at every annual meeting and go, oh God, I wish I had bought the FANG.
Should have bought more Bitcoin.
Well, yeah. Right, yeah. Because he knows the way to make money. Now, it doesn't work all the time, but it works for him. And so what I'm saying is with Lightning Kiss, what you're doing is saying the sample size is 1, me, right? Oh, I've made money. Oh, okay, so therefore you can make money too. Yeah. How? Oh, well, you just buy the FANGs. Right, do you want to talk about valuation?
Overcome nerves.
And then, but again, he then goes on to say, oh, well, high PE equals high moats. No, it doesn't. It means irrational exuberance. There's plenty of stocks that have got high PEs that don't have a moat. Now, the question is, does it last for the next 10 or 15 years? Probably not, right? I mean, that's what I'm saying. There's all of that stuff where people, and we were just talking about it before outside, right? People buy property, they become successful, so what do? You guys should be buying property like I did. And it's like, guys, that was 15 years ago when property was cheap. Now it's expensive. Don't think you can replicate it. If you did, if you had that and that was correct, what that would mean is it doesn't matter what asset you buy, it just goes up. Well, that's clearly wrong, right? Because there's a thing called market cycles. And if you said Sydney property is just going to climb forever, it's like, okay, well, I'll pay $5 million for a property. Why? Well, at some point in the future, it's going to be worth more. Well, that's wrong, right? That's wrong. Now, it may take 2 years or 3 years or 5 or 10 years to be wrong, but the fact is, if you get told that property is a long-term investment and, you know, you need to hold it for 20 years, God knows why, because you're paying off a goddamn load for 20 years, and 20 years later you'll see the fruits of your labour, maybe. Okay, well, that doesn't sound like a great idea to me, to be quite honest. And it's the same for stocks.
But it's a leverage thing, right, as well.
Of course it is.
For most people, you know, you can play with $100 and trade with $1 million, basically.
Yeah, well, it's what you're saying with leverage, Tom, right? You know, I've got 100 grand. I'm going to go and borrow 10 times that, right? And if I make 10%, I make 100 grand. Mm-hmm. Okay, that's great, but it's really, really risky.
And harder to do for the stock market, you know.
Go to a bank with 100 grand and say you want $1 million to invest in the stock market. They'll kick you up the arse.
Yeah.
Or you can get a margin loan at like 11%.
Yeah.
Right? And
that's my point though.
Yeah, exactly. Yeah. But if you go in there and say, listen, I want to speculate on a property, sure, no worry, here's $1 million. Actually, why don't you do 1.5?
we can give you 2. Well, here's another thing. Monday, someone else that you rarely agree with, Mr. Oliver, is talking about the changes that COVID are bringing, and we talked about it last week, and the effects that the long COVID especially is having in Britain on unemployment rates and the economy slowing. But just to touch briefly on it this week as well, we're trying to build, the UK anyway, are trying to put in. Or trying to do a bit of research into curing long COVID, and
there's 7 impacts.
There's 7 impacts of it. You can see. I can't see that. My eyes are like knackered. What is it?
What are you, bloody well asleep or something?
Yeah.
You want glasses, mate? Number one, bigger government and more public debt. That's what we said. That's what the 4 C's is about.
Yeah. So, do you want to expand on it?
No, you keep going. Number 2's there somewhere.
What we got? Number 2, tighter labour markets and faster wages.
That's what
wages growth. Or are you saying we're saying that as well? Or are you saying that as well? I'm saying let's appreciate Steve at this moment for being correct. Well done. Anyway, continue on. Oh, we got I'm loving it. Number 4, higher prices, inflation, interest rates. What happened to number 3? I've actually scrolled past it, hey? That's how bad my eyes are. Number 3, reduced globalisation and more geopolitical tensions. Hello. That's an important one. Keep going. This is like a bingo card for me. 5, worse housing affordability. No, I don't agree with that one. Why don't you agree with that one? Because the housing affordability is not going to be awful forever. It can't go on forever, right? Herb Stein, famous economist, if it can't go on forever, it will stop. It's been going on for a long time. Yeah. Number 6, working from home likely here to stay. Yes. I don't agree with that one though. I think we're going to move more towards going back to business because of the economy slowing down because of decreased productivity.
Depends on the industry, though, I think.
Yeah.
Tell me what you were saying at the coffee shop with your company.
Yeah, I have no mandate to be in the office.
Yeah.
A lot of people in this industry, same sort of thing. Like you're expected to be out anyway.
Public servants are the same.
I think the people want to, and this is probably going off topic, I think the people want more flexibility and the ability to work from home or the office if they want to.
Yes.
But we're seeing slower productivity and more inefficiencies. And
what, from working from home?
Yeah. No, and the only reason I say that is because I speak to business owners daily, and they're like, we've got decreased profits because people are doing half the amount of work.
I suppose, yeah. There's going to be statistical outliers, right? There's going to be people that take the piss or aren't.
Oh, what? There's employers who don't? Oh, please, come on.
No.
Well, my point is, I think we're going to move towards more of a hybrid model, not specifically.
Yes,
working
I
from
would
home.
100%. I would agree.
It's
You
not
can't-
like
you
they'll
can't-
get rid of the office.
Well, of course not.
No.
But also, too, if we're talking about building factories and stuff, well, you clearly can't make semiconductors in your garage.
Yeah.
You've got to turn up and make them at scale.
You can't
and-
just not have commercial property.
Absolutely.
anymore.
Yeah. I don't disagree. But what I'm saying is working from home is going to be a lot more prevalent for white-collar jobs that you can. And again, as Oliver is saying, because, gathering in groups is going to be a little bit iffy until we're able to treat COVID like the flu, where we go, you'll be all right, dude, just go down and get a shot and, you'll be back in the office.
I mean, I don't know about you guys, but I find like you get way less done in the office because, people want to stop for a chat and it's tempting, and then you get, you might go for a bite with your colleagues.
It's just about control.
in your industry.
Well, but if you're at home, it's just like, well, might as well work.
Yeah.
Yeah, and humans
actually get stuff done.
But humans are social creatures.
Yeah.
So when the internet came in, what they said was, this is it. It's all over, right? Everyone's going to shop on the internet. No one will go to shopping centres. 100% wrong, right? Shopping centres fought back. They had better shops. They had lots of entertainment, right? The same thing happened with Netflix. Oh, no one's going to go to picture theatres. Well, that was bullshit because we all go to picture theatres. Why? Because they introduced, big fat seats, alcohol to watch movies, smaller theatres. So in other words, there's a response by those industries that are going to lose out, right? And I think, one of the things you want to look at is suburban coffee shops, right? Because there's a lot of people working from home, right? So, in the city, particularly in Brisbane City, there was a bloody coffee shop on every corner, right? Because all the public servants would go down and get a coffee, right, 2 and 3 times a day. Well, if they're not in there, those coffee shops are dead. But the suburban coffee shops are like, hey, this is great, right? And you're seeing that throughout Brisbane. I went to one on Tuesday that was like, like if someone had said to me, this is where the coffee shop is, I'd have gone, what, you're crazy, there's nothing else there. The bloody joint's jumping at 9:30 in the morning. Right? People working from home, people doing shift work, right? People doing all types of work, and they're all like, oh, I'm going to go down.
It's funny, right, isn't it? Because bills are increasing. People are complaining about not having any money, but the coffee shops are full.
Yeah.
Yeah, it's because, I don't know about you, but I believe not too many people in our generation will go without. If they can't afford it, they'll just try and make more. So I'd rather work the second job than
And get a
skip the
coffee.
morning latte and the lunch is out,
Yeah. Steve's,
Righto, next
Steve's
one.
pointing at the 7th. No, I've been through 6 now, I think, haven't I? 6 working from home,
Righto.
which we talked about. We all
Righto.
disagree for once. And 7, faster embrace of technology.
Yep.
So that's obviously going to happen. It's been happening for a long time. However, the interesting thing on like Zoom stock, for example, which is
Yep.
down however many percent, and the
85
and the Peloton, is it that stock?
Yeah, yeah,
throughout
yeah.
COVID's down heaps. So it just shows that people move quickly between what they need at that particular time.
Well, yeah, and you've got a lot of liquidity in markets, and as you guys know, with a click you can buy whatever stocks you want.
Yeah.
So you can sell Zoom, and 5 minutes later you can have $1 million invested in
Yeah.
something else.
Well, COVID was Zoom and Microsoft Teams and things like that, and now it's AI. But what I think about is, well, Zoom's just dropped 85% in the last 3 or 4 years.
Yes.
So what could AI do if there's a new best thing out next year?
Exactly, and that's exactly what goes on. Already there's starting to be a few people say, listen, AI is not as good as you think it is. Now, it doesn't mean, and this is what we talked about, I think, in the last one, which is what's the price? AI will revolutionise things. Absolutely, no argument. Electricity did, airlines did, railways did. But the question is, as an investor, what's the price I'm paying for this revolution, and is it undervalued or overvalued? Nvidia's what? PE of, I don't know, 90, I think I said. So
They've got to make new numbers up for Nvidia's PE.
Well, but that's what I mean. You know what I mean? It's like Nvidia will change the world. Great. So I'll just buy it. No, because it's overvalued.
Yeah.
That's what you want to think about as an investor.
Look,
Yeah.
Wednesday, we shared another article in regards to government focusing, spending on building up factories,
Yep.
productivity, deglobalization. So we probably don't need to go on about that again. We spent a
Been
fair
through
bit of
that.
time on last week.
Read the article.
Absolutely. Did you want to kind of touch on Thursday, Steve?
This boring sector is becoming sexy again. I just put that in there because we've been talking to people about hard assets. We talked a few weeks ago about it. And what I'm trying to show people there is the reason is just supporting our argument by lots of people make predictions and then when they go pear-shaped, they don't talk about them anymore. So what I'm trying to do here is saying, listen, this is our 4Cs framework. And if you want the document, go on the website and download. Is that right, Jacob?
Yeah, it's on the website now.
Okay.
Yeah.
So go and read it. Then, because what we're doing is saying, here's the backdrop to how you should be thinking about investing over the next, 10 or 20 years. And the reason is because it's a different world. And so, therefore, when someone, as Jacob was saying earlier, when someone goes commodities, you go, commodities, they've been terrible. That's exactly the reason why you should start looking at it, because the world's changing, right? So what I'm doing is saying you want to invest, you want to look at sectors that I think we talked about, Tom, before: shipbuilding, defence industries, defensive sectors.
Yep.
Right? That's what I'm trying to do, is build people's knowledge to go, oh, okay, those guys were talking about, okay, yeah, that's moving in the right direction. And that's what I'm trying to do. So I post these articles as a sort of proof, if I can put it that way, of saying, look, we talked about infrastructure, and look, Wednesday, like you were just saying, right now the new head of the Future Fund is talking about, putting money into infrastructure, being a catalyst for industrial policy, right? And that's what I'm saying. So people go, right, yeah, okay, yeah, shipbuilding. Oh, I better go and look at maybe steel investors like Blue Scope Steel.
Yeah, well, I was just going to say, what are the other defensive sectors? So you got utilities, consumer staples,
Yep.
those kind of things. Anything
Yes.
else that you can think of top of your head?
Pretty
That are-
much, in Steve's words, all the boring shit.
all the boring
Yeah,
stuff.
industrials, materials. That's why I'm saying Australia, our stock market's been terrible since 2007, right? But I think we're going to do a lot better over the next decade, because we've got resources, we've got land, we've got energy, we've got space, right? We've got rare earths, and we're now activating an industry policy. So in other words, we're now rebuilding the infrastructure again, right? So there's going to be lots of opportunities in those old things there. People go, what's industrials, right? Is Nvidia in industrials? It's like, no, dude, that's yesterday. We're now talking about a growth runway of, like we talk about defensive stocks. If you're a bomb manufacturer, you've got a pretty good future coming.
Yeah. So the economy, Australia's economy might do well, but that's not necessarily saying the stock market's going to do well.
Yeah.
Particularly if the US ends up taking a turn down, or if it just stagnates as well.
Yeah, it's a bit of a weird situation, because it's hard for me to explain, in a 10-minute podcast. But what I'm saying is, in the old days, and I mentioned this, I think, in the last one, in the old days, when I was your age, we didn't think that much about investing and speculating and buying property. And, there were a few people doing it, but it wasn't widespread. And the reason why was because we had secure employment. Right. So after World War II, when the government started spending a lot of money, everybody had a job. Well, I don't need to, what's all this talk about speculation and stuff? I'm doing all right. In other words, you can see your future getting married, having kids, buying a house, and, settling down.
But you could, like back then, right? You could work at a factory, support a family,
Absolutely.
buy a home, have the wife stay home with the kids.
Yep.
And, come home at 5 o'clock and just hang out.
In 1980,
Imagine.
about 1985. No, it might have been a bit later. No, it was later. It was about 1990. No, 1980. Interest rates were about 18%, and people were still buying houses, and people were still borrowing money. Why? Because they could afford it on the income. The problem we've had, and for you guys or the guys of your generation, is your incomes are not high enough to support a loan to buy a property. And so that's why, and the same thing was in the United States. Interest rates are one mechanism, but the important part is having a sustainable income to pay for the loan, right? Even if it's at 15%.
Yeah, it all comes back to the price you pay.
Well,
right?
it's your income, right? Because, and it's generally quite relative, but what you've seen over the last 15, 20 years, the wages have fallen, right? And what that's done is it's made it harder for you to borrow. It was all right at 2% because, it was cheap. But now that interest rates are 6 and 7%, what you're doing is looking at it saying, man, I cannot afford that. Right, because your income is not enough to cover it. But you imagine if I said, Tom, I'm going to award you a 10% pay rise. You go, oh, actually now I can get a loan. Right, that's the difference. And so to tie it back, Jacob, we're going back to that period, I think, because we're going to have full employment. So people are going to say, well, I don't need to take a lot of risk because my future feels quite secure. Right. Whereas before it was like, dude, don't lose your job. Oh, man, you'll be on your own and homeless and blah, blah, blah. Whereas that's, as I'm saying, now, there's a lot of people going, this job sucks. I'm going to another job and it's going to pay me more.
Yeah, it's an employee's market. One thing I've just thought about was...
Exactly.
I mean, think about over the last, let's just say 60 years, we've gone from single, to your point, Tom, single income households being able to afford a house.
Yes.
To wages not really going anywhere, but moving actually to dual income households.
Yes.
Which would have, well, that's one of the reasons I think that house prices obviously increase significantly as well, because two people can pay for a loan.
Yep.
So they're going, okay, well, if I wanted to buy a house, I could buy something that's $800,000, but if we both did it, we could get something for 1.2.
That's exactly right. And people will generally, if people believe property is an investment, whether it's a home or an investment, people will max out the credit card most of the time.
Yeah.
Look, there'll be people who say we can borrow $1 million and we borrowed 600,000 because we're eminently sensible people. There's most people who go, yeah, man, I borrowed $1 million and I, lied on the loan application and, yeah, we'll be all right because we think the property's going to be worth 1.5. That's, I mean, let's be honest, that's what people do. Jesus,
It's an ego thing as well.
Mate, I did it 23 years ago. Like, how much do you earn? A lot. And the wife, and what do you got? And what's that worth, right? Oh, look, there you go.
Look at the house we can get. Look at the pool.
Well, we just kept going back to the mortgage broker and going, can we borrow more money? Yeah, and what's that property? Oh, well, that's worth an extra 100,000. All right, there's the equity for the next one. I mean, seriously, that's what people do.
Yeah.
But you've got to get in to start with. And like you say, Jacob, a lot of the time it's, these days you need two incomes.
For sure.
Was it you we were talking about earlier about, buying a house with friends?
No, it was Tom. It was, right. What were you saying, Tommy? The people are starting to buy houses now with their friends and families to pay down the loan quicker.
Well, I know that kind of thing's popular in a lot of other cultures. Mm-hmm. Yeah, I don't know if too many people are doing it here.
I saw an article about it during the week. There was I didn't read the article, but the headline was, how to buy a property with your friends. Which I just went, oh, Jesus.
Yeah.
Doesn't matter if you don't get on.
Yeah, who's going to live there?
Well,
share it.
Yeah, you get on to start with, but...
Yeah. And then you find out that those sons of bitches don't replace the toilet paper the right way.
It's not worth it.
And the toothpaste.
Not doing it.
They keep drinking the milk.
So do you want to buy a house together, fellas?
Probably last thing, did you want to talk about the chow?
The chow of the week, the cow.
The chow?
It's defensive sectors again. So we're at all-time lows. The ETF market share of defensive sectors are at all-time lows. And to put it in perspective, 2009, just after the GFC, would have been the next low. So it's been a while since we've been down there again, and it's the reason we're talking about this is again talking about the capital flow and money coming
into tech stocks and stuff.
Yeah. And countries now going, okay, well, we're not too friendly with everyone else, so we need to start building more infrastructure onshore, ships, bombs, and things like that. So I think it's an interesting, when you're looking at defensive sectors and defense sectors, not to get the two confused.
Yep.
It could be a positive next decade.
Yeah, because it's also about, it's also about value versus growth. Tech stocks are growth stocks, right? And growth and value, again, do mean reversion, right? Growth gets a great decade, then value kicks in. Now, value's had a really rough time, but it's still done all right. It just hasn't kicked the lights out like growth has for about 15 years. So again, what you're seeing now and what I expect is there will be better investment returns in value stocks. Now, value stocks are generally the old, boring stocks that pay a 6% dividend, right? And at the moment, well, nobody wants that when you can buy Nvidia and Facebook and Netflix and the Fang Gang and all that stuff. So at some point that turns around when the market crashes and people go, well, there's not going to be any growth, so what do I do now? Well, now I look for dividends. What are dividend stocks? Generally value stocks.
Yeah. And look, I think the point here, right, like the cost of hedging or diversifying is way cheaper than usual because no one wants to.
Yes,
It's out of favour. Tech's making $1 million. I'd be daft to have my dollars in something that might just tick along if I can go and, double my account in the next
This is the time when
days.
you might want to think about buying a put option, right? Because you can say, all right, I'm going to spend, just for argument's sake, right, I'm going to take $5,000 and I'm going to bet that the US market falls from about 5,300 or whatever it is at the moment, somewhere around there, and I'm going to buy a put option and it's going to fall to 4,000, right, in 12 months. Now, because, as you said, Tom, everyone goes, oh, mate, that's not going to happen. Everything's fantastic. It's all good. And you say, well, I've got $5,000 to spend. People will say, all right, well, I'll sell you a put option for, $2, right, per contract, right? So it's really cheap, but if it comes off, your $5,000 becomes 105,000, and if it doesn't, well, you lost $5,000. But it's an asymmetric bet where
not financial advice.
Definitely not financial advice, but simply saying that it's like in 2009 when everything's really cheap. Well, no one wants to buy the stock market. Why? Because they think it's going to fall further.
Yeah.
Right, and that's the time when you go, well, hang on, the yield is about 10 or 11%, so this is actually a really good time to buy stocks. Bingo, right? And so that's why I put it in there to say if you look at defensive stocks, defensive sectors, they're really cheap. And you think, oh, yeah, but they're going to be cheap for ages because, everyone's buying tech stocks, but that won't run forever.
Yeah, the narrative will shift.
Yep.
And hopefully you've got in early.
Indeedy Lamborghini.
After hearing us harp on about it.
All right, are we done?
Our informative debate.
Ooh. Absolutely. I think we'll bring in a new section as well on who's on Steve's shit list.
Yes, let's do that.
Well,
who's your problem with this week?
Well, there's plenty to choose from.
We'll make another 100. All right, well, good to see you, gentlemen. We'll see you next time, hey? Thanks, guys.
Cheers.
Thanks,
folks.
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And as always, remember, we don't provide financial advice.